The Federal Reserve has a problem, and this time there is no easy button, because the Fed is stuck between two risks pulling in opposite directions. On one side, inflation is not fully gone. On the other side, growth looks fragile enough that staying too tight for too long could create a different kind of pain. That is the trap. If the Fed cuts rates too early, markets may think it is relaxing before inflation is truly under control. But if it keeps rates high for too long, it risks putting more pressure on borrowing, business activity, hiring, and consumer demand. And this gets even harder when energy prices turn unstable. Oil has already shown how violently it can move during the Iran conflict, with sharp jumps during war shock phases and later reversals when geopolitical expectations changed. That matters because energy does not just affect prices, it affects psychology. Even before higher fuel costs fully spread through the economy, households, businesses, and investors start thinking differently. Fuel feels less predictable, transport feels more expensive, and suddenly inflation does not feel fully defeated anymore. That's why investors are obsessing over every jobs report, every inflation print, and every move in oil, because the Fed is no longer dealing with one clean problem. It's trying to manage inflation risk, growth risk, and energy uncertainty all at once. And that's exactly why the market is hanging on every word. If inflation stays sticky, the Fed has less room to support the economy. If growth slows faster than expected, pressure builds for the Fed to respond. And if both happen together, markets start whispering one ugly word: stagflation. That's why this matters to regular people, too. Interest rates are not just a boring policy topic anymore. They affect mortgage costs, business loans, credit cards, stock valuations, crypto sentiment, and the overall mood of the market. So when people ask, why does every Fed comment move markets so much? The answer is simple: because investors are trying to figure out which mistake would hurt more: cut too soon or wait too long. And right now, the Fed does not have a painless option. It only has a series of difficult ones. That's why the next few months matter so much, not because the Fed can magically fix everything, but because every decision now carries a bigger cost than usual. So this is not just a story about interest rates. It's a story about how one central bank is trying to steer through inflation risk, growth risk, and energy uncertainty all at once. And that's exactly why the market is hanging on every word.